Hi, my name is George Dagnino, and I'm the editor of the Peter Dac Portfolio since 1977. This is the second presentation of a six-part presentation on how to protect your portfolio from devastating events. Again, let me remind you that the first three parts deal with what are the assumptions that you have to make to manage your money, and then the last three presentation deal with the issue of say, okay, what am I going to do with it? What are the techniques and strategies to manage my portfolio? As I mentioned in part one, in order to manage your money and prepare yourself from devastating events, you have to think different. So the first three parts of these presentations is to show you what are the risks and what are the assumptions that I make in preparing ourselves to protect our portfolio. And this is how I manage my money. My objective is not to get outrageous returns. No, that's not the objective. The objective is to manage risk. That is to minimize the probability that you're losing a lot of money. And I am convinced that one way to do it is by reducing portfolio volatility. And the reason is if you have a low volatility portfolio, you have time to correct for mistakes that one necessarily makes. The first part of the part one of this series of presentation was dealing with on the issues of leadership and can we trust our leaders and what's happening when they act and what drives their decisions. In part two, instead, I would like to examine the record of several of gurus when they, including myself actually, in making their forecast. And let's see if we can learn anything from this analysis. PIMCO is a tremendously skillful outfit. And PIMCO strategy meeting, I listen to them and review them quarterly. They have quarterly meetings, and they discuss the outlook for inflation, interest rates, and all that. And believe me, they were expecting when I was following them higher inflation, higher interest rates, and it didn't happen. So smart people as they are, they were really did not have a good batting average, or at least I learned to think, should I trust what they're saying or not? However, what is interesting that in spite of their poor forecast records, I think, they have excellent returns. Why? Because the way they invest their money is not based on their forecast, or at least it's probably based on their forecast, but mainly is based, in my humble opinion, on their deep, sophisticated knowledge of the markets. They know when countries want to need to borrow money, they go to PIMCO. They know the details of any market in the world, so they know how to take advantage. And I sense that is largely independent of their forecast, but more from their decision depend on what they learn from feet on the ground, so to speak. Well, let's take another example of forecasting. And I saw this on TV, by the way. It was just at the beginning of the subprime crisis, and I saw a Fed governor. It was a blonde. I'm not going to say names, but it was a blonde lady, and it was a little bit overweight. And it was telling the interviewer that the subprime issue was under control, was really not a problem. And I follow this lady, and I know that eventually she left. No one really mentioned it on TV that she was under the governor, that she left and became a big shot actually at a major university. So she was an expert, and she said that subprime was not an issue. And of course, we know that subprime created the biggest recession, the Great Recession of 2008, 2009. Let's take another example. in 2007, and this is a matter of record, you can go on the internet and find out, as the Fed was staring at a major financial crisis, an economic crisis, they were predicting 3% growth in the official statements after their meetings. So that tells you what kind of capabilities, how difficult it is to forecast. This chart shows again the record of the forecast made by the Fed from 2011 to 2013. As you can see, their forecasts always start very high, and eventually they have to decline and come to reality, because that's what the actual is all these lines over here. And the same thing in 2012, and the same thing, they started high in 2013 and they started high in 2014. They always start very high, their forecast, and then as the real life comes about, they slowly come down to what is supposed to be. So the odds, should we believe their forecast? Well, I'll let you decide. They're saying that debt, excessive debt, is causing slow growth. Actually, I think it's the opposite. Debt is the symptom, it's not the cause of our problems. The reason we have large amount of debt is because we have to borrow to buy things that we cannot afford, and we are not producing. Really the cause is that we are not productive enough, efficient enough to grow faster and create more wealth. The other thing that one of the outcome of large debt is that it's transferring wealth from us to the bondholders. Bernanke, the second other item is that Bernanke believes that Q infinity it is used as needed to escape depressions. Well, maybe he knows that, but he's also saying that that's very experimental, what he's doing right now. Quite frankly, if you look at what happened to the stock market, to the bond market, people who can borrow at 0% interest rates and buy large amounts of stocks and bonds, they made a lot of money in 2009 through 2013. On the other hand, people who are retired and need income, they cannot achieve income because the interest rates are zero. So whatever is done may be, but doesn't seem to be the right thing, in my humble view. But who knows? Hussman is a great economist and portfolio manager. I look at his website and I literally study his weekly letters and reports on his blog. Extremely well written, extremely proves that everything that is happening is wrong. However, he has been bearish through a long period of time, saying that the market is overvalued and giving fantastic reasons, but the market in the meantime rose more than 100%. Another time there was Fisher was predicting stock market based on earning per share and bond yields, and he was bullish in 2008. And he's considered a great forecaster, but again, he was predicting soaring markets just at the time when the market collapsed 40%. CXOAG is a very sophisticated website, and you have to be a subscriber to access it, but some data made available for the occasional visitor. And what they do in this, one of the many things they do on their website is that they rank the forecasters. And the best forecaster are 60% right. And usually, and by the way, Fisher is one of the best forecasters. Why they have a 60% batting average because they always are bullish. And they know that by being always bullish, you are more right than wrong. The point, though, is, as in 2008 for Mr. Fisher, and I don't want to pick on him, but it's an example that I'm aware of, is how do you know that they are 40% wrong? So how do you know when they're wrong? Yes, it's true they're mostly right, but if they're wrong, like in 2008, and you're losing a ton of money, then what is worth to follow a great forecaster? So that's the problem. How do you know when they are right? That's the big risk. And who's the winner? Now, if all these people, the great leaders and the great forecasters, are so smart, how come we are in the big mess of created in 2007 with an economy that is just stuck in the mud? What is the point of part two of this second presentations? There's the forecaster predict the average outcome. They know that by always expecting a market going up, they are 60% right. But then again, they miss the 40%, the devastating event. They cannot predict the fat tail, which is the devastating event, the things that no one can predict, no one can expect. And even if they can tell that eventually there is going to be, for instance, hyperinflation, or there is going to be a crisis, and even if they do, predicting the timing of this devastating event is almost impossible. How many years very famous people are saying there's going to hyperinflation because of what the Fed has been doing from 2009 to 2013, but yet we are having, as of this presentation is recorded, we are having almost deflation. And besides, who do you trust? Thank you very much for following me on the second part of this series of presentation, how to protect your portfolio from devastating events, continues in part 3.